Hello everybody, here as today something special. Here is a kind of a case study challenge. And the idea is just at the end of your studies you should try out what you learned and try if you can answer questions of potential future employers on what you learned. So that requires that you can deal with some comprehensive stuff or so. So here is a case study for you as a kind of final reflection of all what you learned or should have learned. So the challenge is what? I publish a task, but not the solution. So everybody of you will have to form an opinion and is allowed to post in the comments your own remarks on which details you would solve which way. You are allowed, welcome, and even expected to give answers in the comment section to this video, make suggestions about the right way to a solution concerning some details which interest you, where you think you can contribute. Naturally, I'm not going to take part in the discussion. I will refrain from comments myself. However, when you write comments on what others have already commented, so be nice. So don't write others that they are idiots, because usually they aren't. It's far better to say, I'm not completely agreeing with what you suggested. I have another idea, and then give your reasons for it. As the case study is a bit long, you should probably organize your comments in a systematic way. That means there is a part where there is a corporation and its situation, a sole tradership and a partnership. Some private investors of the owner are also described. And at the end, one will need to add the overall results. So when you comment details, then refer to, is it Roman letter 1, the corporation tax situation? Is it the sole tradership? Is it the partnership situation? Or is it the other things? So if it's possible, try to organize your comments in a way that becomes clear to what you comment, and that's probably a good service for the other readers and the other persons who are interested in what we are doing. Well, so let me introduce to what's going on in our case study. The first part is just introductory information. So which year is it all about? It happens here in year 03. That means that doesn't mean the year 2003, but it's the third year since the beginning of the world in the case study, and during all years the present legal situation was the legal situation of today, so that we never have to bother with transitional problems. The persons involved, that's mainly Albert Miller. He lives in Aachen, Germany, but also has a secondary residence in Amsterdam in the Netherlands. And his home in the Netherlands is, however, only used for occasional stays there, and rarely he passes a holiday there in the Netherlands. His family lives with him in Aachen and also uses the home in Amsterdam only occasionally from time to time. And when it comes to citizenship, well, then it's simple. Mr. Miller has only the citizenship of Germany. In the end, when you need or want to calculate the total German income tax which is due by Albert Miller, then you will need the German income tax tariff, and as not everybody has that tariff available, I just give you the most important data here on the screen. The income tax is 45% on all your income minus a deduction factor when your income is higher than 2,785. If it's lower than that but higher than 62,809, then you pay 42% on everything minus a correcting factor again. So Now let's go to the different facts of the case and let's have a look what's really happening. The first thing what we have to talk about is the Albert AG. That is a corporation, a stock corporation established under German law. You see that from the abbreviation AG at the end. And they have their statutory seat, that is for English persons the registered office, and their place of management in Aachen in Germany. So the Albert AG is a juridical person established under German law. A huge percentage of the shares of this company is owned by Mr. Albert Miller, namely 45%. It has statutory seat and place of management in Aachen, as I already mentioned, and you will probably need the trade tax rate of Aachen, that's 475%. For all those who are not familiar with the trade tax law of Germany, please don't be shocked. These 475% are levied on an artificial tax base, which is considerably low. It's approximately 3 or 3.5% of the profit. So 475% is approximately some 15%. So don't be shocked. You can go on speaking with Germans in the future still. So don't be too much shocked. The Albert AG has an accounting period from the 1st of July 02 to the 30th of June in 03. And during that commercial accounting period, the profit which came out was determined as, a mass of figures, 11,435,908 euro. Now this figure has been computed under the influence of the following events, and these events which I mentioned in the following were always treated correctly under commercial law. If not, the description shows that something has been made wrongly. So the first thing which we have to talk about is Albert Miller worked as an employed manager for the Albert AG. And for this activity, he got a monthly salary of 25,000 euro. A comparable employee who is not a shareholder would have been paid only an amount of 15,000. That managing director's salary remained unchanged also in the next accounting period, so till the end of December of 03. The Albert AG has a branch in Amsterdam, Netherlands, and this branch contributed 1 million to the total commercial profit of the enterprise. Albert Miller used 5% of his working time to manage the branch in Amsterdam. For this, he traveled there for half of this time, so 2.5% of his working time, and the other half of the time he spent working time for the branch in Amsterdam, Netherlands, in his office in Aachen. Naturally, you sit at your desk in Aachen, and some of your time also is spent for managing questions concerning the branch in Amsterdam. Until now, this has not led to any specific consequences for the computation of the tax profit, because Albert's salary was completely deducted as a business expense. That is what had been booked, and there has been no differentiation concerning what refers to what here of that salary. The company in question has a supervisory board. They have 11 members. By the way, don't nail me down to the wall or so. I don't know how many supervisory board members the German AG has to have under which circumstances, so I just took 11 because it's a nice number. It's probably wrong. Perhaps they need 21, perhaps they need only 5. So don't rely on me when it comes to that aspect. We got it just as a given fact and think it's true. Huh? 3 members of that supervisory board come from the USA. The remaining 8 members come from Germany. And each member of the supervisory board got a remuneration for his or her services of 18,000 euro, so that the total amount of all payments made to them was 198,000 euro. Now the payments to the 3 foreign members of the supervisory board have been treated as follows under commercial accounting. Some accountant booked debit record expense for supervisory board members 36,909, and credit record bank 36,909. Then again, debit record taxes on income and trade profit 17,091. And the credit record for this was liability to the fiscal authorities over the same amount. And then was a debit record on input tax claims 10,260. And the credit record was liability to the fiscal authorities because of value-added tax 10,260. The payments made to the other 8 members of the supervisory board had been fully treated as expense for supervisory board members, and the postings had been here in total expense for supervisory board members 144,000, credit record bank, and input tax rate claims 27,360. Also, that was transferred by bank transfer. So the bank in total had a number of 171,360. So Albert Miller then let a building of his own to the company as an office building from the 1st of January 03 onwards. So think of it, when the accounting period here began. The AG paid a monthly rent of 11,000 plus VAT if possible for that building. An adequate market-conform rate would have been 16,500 euro, again plus VAT if VAT can be charged in this situation. Albert Miller had bought that building for cost of acquisition of 550,000 some years ago. He had to pay for some repairs in June an amount of 66,000 plus VAT and had current costs of in total 55,000 for the whole calendar year. So electricity, water, maintenance, whatever he had to take care of. Here you are required to comment the consequences for the AG, but also the correct VAT treatment and the consequences for the owner, Albert Miller, personally. Albert Miller does not want to treat the office building as a business property under his income tax declaration, if that is possible. Number 6. The Albert AG has recently acquired a building in Monaco, a country where there is no double taxation treaty between Germany and Monaco, for cost of acquisition of 500,000 euro. The building only serves as a capital investment for the Albert AG and is therefore meant to be let to tenants only. They don't use it for their own entrepreneurial purposes. It's, however, already let to tenants, so they could obtain a revenue of 50,000 as rental revenue. There were, however, high repair costs, which could correctly be treated as deductible expense, 60,000 euro, and the depreciations for the building were calculated with 2%, and we just assume that to be correct. So, and indeed that would be correct if it's not a building which has been completely recently built. So, all the depreciations which were claimed by the Albert AG, with the exception of those named in number 6, and the depreciations relating to the branch in Amsterdam, amounted to 10,100,000, and under the rules of German tax law, only 10 million would have been allowed. So, commercial accounting charged more depreciations than would have been allowed for tax. Interest was received for a loan which had been given to a shareholder. The payment was 55,000 euro, and an adequate interest would have been only 52. Interest was paid by the German headquarters to a foreign shareholder in UK for a loan they had received. Under the contract with that shareholder, the interest payment should have been 100,000. According to market conditions, the interest should have been 60,000, but strangely, the bank transfer to the foreign shareholder had only been 89,450. The posting made by the accountant had been debit record interest expense 100,000, credit record bank 89,450, and liabilities to fiscal authorities 10,550. By the way, when you treat or solve the case, please give a comment if this is correct, why it's correct, or if it's wrong, why it's wrong. Interest had been received from an Italian subsidiary. Participation in that subsidiary is higher than 20%. 165,000 euro. Adequate would have been 156,000. So in Italy, only this last mentioned amount had been accepted as business expense. They didn't accept the exceeding 9,000. And so the question is, what are the consequences naturally here in Germany? The Albert AG paid interest to banks and others, in that case no shareholders, with a total amount of 17,648,000 euro. And last but not least, the Albert AG expects that it will have to pay a fine for the violation of cartel law in the next year and has for this reason recognized the provision of 3 million euro. For corporation tax, the expense for prepayments and for the provision of the final payment amounted to 3,750,000 euro. The corresponding amount for solidarity surcharge amounted to 5.5% of that, and furthermore, in the first month of 03, the final payment for the previous year was made to the fiscal authorities by bank transfer, so the debit record was liabilities 210,011 euro. Credit bank record was bank transfer 210,011. Trade tax prepayments plus final provision led to expense of 4,781,392. And what you should do here is find out the amount of corporation tax due under German law and the trade tax due under German law here. Now, our good friend Albert Miller has also an own enterprise, which he runs in the legal form of a sole tradership. So in Germany, he would have the official abbreviation EK at the end of his firm's name. And this enterprise occupies itself with the production of different goods and trade activities, so they do everything where money comes from. And the accounting period of the firm is identical with the calendar year. For this year, a commercial loss came out of 105,422,020 euro. And sorry, 2003, that doesn't exist with euro cents. That's a printing mistake. And another printing mistake is directly above. The firm consists of the headquarter in Aachen, a further permanent establishment in Bonn in Germany. And you probably still know Bonn. It was 30 years ago, or some 35 years ago, the seat of the German government. And they have a permanent establishment abroad somewhere in Brazil. Now, the city trade tax rate of Aachen is 475%. The city trade tax rate of Bonn is 490%. And the fiscal office has already determined that the ratio of the wages paid in Aachen to the wages paid in Bonn is 90 to 10. The state of Brazil has no double taxation treaty with the Federal Republic of Germany. First of all, Albert Winner wants to know if, due to his having also a residence in Amsterdam, he could also be taxed there with his income from the permanent establishment in Brazil. Second point, the commercial profit for the whole enterprise amounts to 105,422,020. That's again one cipher too much. And in this figure, we have a loss from the PE in Brazil included, which is 40,000 minus. For some contracts, the permanent establishment in Bonn had made a provision of 55,000 because of onerous contracts in the previous accounting period. This provision could be dissolved this year, and the headquarters in Aachen had, however, seen the need to recognize a provision for an onerous contract this year again, and that provision amounted to 200,000 euro. The firm had delivered one of its products to a customer, an enterprise in Bern, Switzerland, on the 20th of December of the current year. This delivery was made from Aachen. The transport was done with an own lorry of the enterprise, and the product in question reached the customer still on the 20th of December. The invoice, however, was written on the 2nd of January of the next year, so '04, due to Christmas and New Year holidays. The product had been produced for costs of acquisition of €5,000. The payment received from the customer had been 11,900 and arrived on the firm's bank account at the end of January. Based on these figures, a profit of €6,900 had been determined and had already been included in the commercial profit of year 4, because this was the year when the invoice was booked. Give a comment if that transaction has been properly treated with regard to the accounting year to which the profit has been attributed, and if the profit span has been correctly determined. As far as VAT issues are concerned, you can assume that all formal requirements which might be necessary have been fulfilled by the firm. Then, fourth event, there was a notary cost for the acquisition of a piece of land, and it was booked as expense just as the cost of the corresponding real estate transfer tax. Here you see the postings. Expense as debit record and credit record bank 14,000 for the real estate transfer tax, and an expense of 6,000 with a credit record on the bank, 6,000 for the notary cost. Then interest was paid to a bank without further comments, €122,021. An office building had been rented from the 1st of January onwards, and the owner of the building was the mother of Albert Miller, so it stayed in the family. The completely adequate rent payment was 2,000 per month. Unfortunately, now on the 30th of June, the mother of Albert Miller died, and Albert was her only son and heir. And that house in question had been acquired by mother only on the 1st of January of the current year for cost of acquisition of 300,000. The corresponding piece of land for cost of acquisition of 100,000, and on the 30th of June '03, the market value was still 300,000 and 100,000 respectively. After Albert Miller had inherited everything, the rental contract was just continued as before, no change, so each month a bank transfer was still made, and a posting was entered as follows: rent expense 2,000, credit record bank 2,000. Hospitality expenses had been made for business friends, adequate expenses only, with a total of €11,000. Furthermore, our firm holds a participation of 78% in a foreign company in a country which doesn't have a DTT with Germany, so no double taxation treaty. From that, they received a dividend of €39,000. However, since there was no DTT, the foreign country took some tax, 20% on that dividend, as their tax on a limited tax liability. So this tax burden is definitive and you can't get it back. The firm booked the event as follows: debit record bank account 31,200, tax expense for taxes on income and profit 7,800, and the credit record for both was dividend revenue 39,000. After all, there is also some additional information regarding the real estate property of the firm. There is something at the moment still in Germany called the Uniform Standard Tax Value, in German Einheitswert, for the purposes of taxes on capital and trade tax and other things, 55,000. This Uniform Standard Tax Value, by the way, is a very, very old-fashioned, outdated thing. That is why it's going to be completely abolished in 2025, but at the moment it still exists and it has some impact on the one or other tax. So for trade tax, by the way, this value has to be modified by a surplus of 40% under a special rule in the valuation tax law, so to 77,000 euro. Furthermore, our sole trader here pays an annual license fee of 50,000 to the Faraway Limited, a company which has registered office and place of management in the tax-saving islands. This license fee is entirely conform with the arm's length principle. It's not subjected to any preferential treatment in the country of the company which gets it, and the posting for this transaction had been expense 50,000, credit record bank 42 owes 87.50, and liabilities to fiscal authorities 7912.50. Event number 11. The machine was no longer used in the PE in Bonn and had been transported to the firm's PE in Brazil, where it's meant to be used in the future. At that time, the machine had a market value of 110,000 euro. The book value at the time was 88,000, and in commercial accounting, no consequences were ever drawn from this event. Last but not least, the prepayments and the amount for final provision for trade tax amounted in total to 8,520, no, not 8 million, 8,522.20. That is again one cipher too much. Probably I had a bad day concerning typing at that day. So this amount had been booked as tax expense in the commercial accounting. Compute the income tax and compute the trade tax, naturally with giving references to every necessary part of the law and giving reasons why you apply which rule in which way. So if you want to contribute to the solution, give reasons and references for everything which you do. Well, next part is Albert Miller is also a partner in a partnership, and that partnership is active in Germany and in a foreign country. So on the 1st of January of the current year 03, Albert Miller has become a partner in the partnership Fabian Spargel, Elfriede Meyer, and Alf Abdor OHG. He did this by buying the share of the partner Fabian Spargel, who owned 10%, with effect from the 1st of January in the first second of the year. Fabian Spargel then left the partnership completely at that point of time. The partnership runs the factory in Aachen, and the profit of that partnership for all of the partners together has been determined by the common commercial accounting. Most of the necessary adjustments which tax law requires have already been made, but a few single events have not yet been reviewed if they can remain unchanged for tax purposes. So the provisory tax profit, which has been until now computed, amounts to 1,430,000 for the accounting year 03. The events which have not been finally reviewed were the following ones. The OHG paid rent for a building to a new partner per month, to Albert, per month, 2,500 euro. From the 1st of January onwards, the building is used for storage purposes. The market value of the building at the beginning of the year was 500,000. The market value at the end has not become lower. The piece of land on which the building stands also belongs to Albert Miller and had a market value of 100,000 at beginning and ending of the year. And Albert had paid interest to a bank because he had financed the acquisition of the building partly by a bank credit. That was 40,000 for the whole year. The OHG then received number 2, a license fee from a subsidiary company which it owns to 100% and which is located in a country which has no double taxation treaty with Germany. They do it to make our lives easier. The license fee was 3.2 million euro. This license fee is far too high. Unrelated parties would only have agreed on an amount of 1 million. For this reason, the country of the subsidiary had indeed not accepted the full license fee as such, but treated the amount of 2.2 million as a so-called hidden profit distribution. They charged a withholding tax of 20% on the whole amount of the 3.2 million. That's 640,000, And this withholding tax has until now not been booked as expense, um, but treated as non-deductible or something like that. So the OHD made a huge profit from the delivery of goods to a foreign customer, 100,000. However, the foreign state into which the delivery was made charged a tax of 10% on the revenue as a withholding tax for the income tax on the profit from this order. So they took 10,000 euro as an income tax. This tax burden can, as there is no DTT with that foreign state, neither be refunded nor reclaimed nor lowered nor anything else. The revenue from the foreign order has already been recognized as revenue, and the foreign tax has been provisorily booked as expense when the provisory tax profit named above has been calculated. As Sonderbilanz does not exist and was not necessary for the partners Elfriede Meyer and Alf Abdor, and has also been never necessary for the previous partner Pavian Spargel. So, if any might exist, then only for the new Albert Miller. Now there is, as you perhaps know, in Germany also a topic called Ergänzungsbilanz. And when Albert Miller had bought his share in the partnership, the OHG had the following simplified balance sheet. The tax book values are here in these columns. And just for your information, you had market values also here. Now, naturally, he paid for his share of the adequate market values for all the assets, and so that might lead for him to an Ergänzungsbilanz, which has also an impact for his results at the end of the year, just to give you that as a hint. And the uniform standard tax value, so-called Einheitswert of all the real estate property which is regarded as business property of the OHG, either in common balance sheet or Sonderbilanz property or where else, is 200,000 and has again to be multiplied by 140% as long as these rules still exist for purposes of trade tax. The total amount of interest payments made by the OHG itself was 50,000. Rent payments for movable property were made by the OHG with an amount of 100,000, and immovable property payments and payments without the rent, which was paid to our partner Albert, amounted to 50,000. So that was everything on the partnership. Now, just to make things nice, we have also something about a faraway limited company, which we already mentioned above, and some private investments.